Hi, it's Dre Griggs of Obsidian Wisdom. Today we answer the question, how do I know if my 401k is underperforming and what to do about it? Is your 401k not growing in the way that you expected? Are you a little concerned whether or not you're keeping up with the benchmarks and other people's 401ks on average? If that is the case, this is the video for you. Because the majority of Americans are funding their retirement plan with their 401k or 403b and other pre-tax plans, it's important for us to know whether our 401k is optimized in a way to make sure that we're able to do everything that we can to have a wealthy retirement. Which is why ultimately what I'm going to share with you today is how I would check someone's 401k and how you can follow that same process if it works for you. The main takeaway that you want to have today is you need to look at your 401k on a regular basis. You should be reviewing your fees and your performance and where you're allocated. And we're going to go through why that's very important. And we'll even give some cadences on when you should be doing those reviews. If you really think about it, if we leave our money in an underperforming asset for 5, 10, and 25 years, then we really are hurting our own retirement. We're talking about hundreds of thousands of dollars that is going to be left on the table, where if we just logged in, looked at the fees, where our allocations were, made a couple small tweaks, then we're able to optimize our 401k in a way where we're taking advantage of time. One of the issues that I often see is because we're not taking advantage of time, it's working against us. Time can either work for us or against us. And what I mean is, if we invest for 30 years and we have a certain performance, then that means that we don't have to invest as much money. I'll put a chart out where I'll share with you different ways to create $1 million portfolio. And what you'll notice is if you start early enough, you can put as small of an amount as $5 a day. But if you start late enough, then we have to increase the amount of money that we can. And the most important thing that you'll notice is if we're able to optimize our 401k in the right way, then we could put in $50,000, $60,000, $80,000 and have $1 million in retirement. But the opposite is also true. If we're not optimizing our 401k the right way, then we have to put in $500,000, $600,000, $800,000 of that $1 million as necessary. And I just don't want that for you. I'm someone who definitely believes that our money should be working for us more than we are working for it. Ideally, as you get closer to retirement, you'll know you're on track because you have the ability to see that when I first start, 0% of my income is generated by my money, but then 100% of income is generated by my time. Hopefully, when you're halfway towards your retirement, whatever that date is, then 50% of your income is able to be generated by your money, and then 50% of your income is generated by your time. Even if you don't actually take any money out of your investment, the ability to generate 50% of your income is key. When you leave the money in long enough, the beauty of compounding interest, which Albert Einstein says is the eighth wonder of the world, all of a sudden your money starts shooting up. This is why optimizing your 401k is very important and why it matters. So let's go over 3 common reasons that your 401k could be underperforming. Number 1 on our list is higher fees. When we talk about the fees inside of a 401k, there are obvious fees and there are hidden fees. And I wish that they weren't hidden, but the reality is they are. I'm going to go over a handful of fees that I would normally be looking at when I'm deciding whether or not I have too many fees and it's actually impacting negatively the performance of my stocks. The reason that you want to keep a track of your fees is because 1% adds up. In fact, and I'll put the chart up for you, you can see here that there's an estimate of someone's 401k fees. Now, it's just simply so we can see what the impact is more than we're trying to figure out exactly what the fees are. So what you can see is if someone is 25, they want to retire at 65, they have $25,000 in their account, their annual contribution is $5,000, and they have a 7% return, you can see that their portfolio with 0% in fees would generate $1.5 million. You can see that almost 1/4% of a fee would decrease your portfolio size by over $100,000. You can see that if you had a fee of 0.5%, that would decrease your portfolio by another $100,000. And you can see if you had a fee of 1%, that would actually decrease your portfolio by almost an additional $200,000. As a result, a 1% fee would actually decrease the performance of your portfolio by almost $400,000. So the question is now whether or not we're paying fees. We understand that there's going to be a cost associated with managing our investment, but it's important to note that these fees do have a cost associated with it. And I need to know whether or not this cost is actually being recouped by my investment strategy. Is my investment advisor doing a good enough job to justify these fees? So the good news is since about 2012, the government has said, hey, look, you got to let people know what the fees are associated with a 401k. So you have that going for you. You can normally start by asking your HR for your 401k's fee disclosure document. You also want to ask them, and they may not know, but it's at least good to ask them, hey, are there any hidden fees associated with our 401k? Now, most of the time, they won't really be able to answer this question in an effective way, but it doesn't hurt to ask. And what you'll notice is your fees are normally broken into three groups. So you normally have your administrative fees, your investment management fees, and then whatever your individual service fees are. We're talking about our administrative fees. It's just as it sounds. It's sort of the keeping the lights on, the coffee warm, all that kind of stuff. You call a 1-800 number, someone that answers, there's a cost associated with that. Normally your administrative fee keeps track of all of these different things. Your record keeping and all the papers that they print, all those little administrative things that sort of need to be done. And it's the cost of the company. They normally pass that cost on to you. When you talk about your investment fees, this one is kind of the big one because it's a percentage of the assets under management. And you will see that you not only look from the investment advisor, but you also look for the actual allocation of the investments. Now, depending on how active the investment management is, that fee can be anywhere from maybe 0.5% to 1.5% of your assets as far as the fee. And that obviously eats up. We already went over that example where you can see that it does matter. And so that number will vary depending on the investment advisor. Normally, they'll say somewhere around 1% is normally what you should expect and what's considered reasonable for an actively managed account. And if it's a passively managed account, then normally we can expect the fees to be somewhere around 0.5%, sometimes even lower than that. But normally you would expect an active management to be higher, which leads nicely into the need to look at our expense ratio of our investments. So depending on the investments that our investment manager is investing in, there's going to be a fee associated with those investments. Those different ETFs and mutual funds have a fee from their own advisor. So again, if the investment advisor is active and they're charging you 1 to 1.5%, but then they invest in a fund that's also active and they're charging another 1 to 1.5%, you can see how these fees can really start impacting the performance of your 401k, which is why we need to take a look at all of these fees. For you to check on the allocation of investments, normally what I'd have you do is you would ask for your prospectus, go ahead and take a look at the different expense ratios in the allocations of the funds that you have inside of your 401k. The third type of fees that we mentioned are individual service fees. So when you look at your service fees, this could be if you have a loan out on your 401k, it's normally going to be something that is unique to you. Whatever the situation might be, there might be a cost associated with whatever that little extra special thing that you have in your 401k. Now, sometimes you don't even know that it's there. Sometimes it's the employer that adds these little special arrangements, and then the cost is blanketed over everyone's individual investments. That is just something that you do want to look at. What are the individual service fees that I can expect to be paying from my 401k? Now, I did mention asking your HR department whether there were any hidden fees. And as we mentioned, they probably aren't going to know. But when you're looking at your statement, or if I'm looking at your statement, what I'm looking for is how actively these trades are traded. Sometimes those fees can come from the custodian. They can be in the form of trading fees, or sometimes these are plan specific fees where there's a cost either from the investment advisor or there's a cost from the custodian for you to have to pay to have access to these special funds. And what makes the fund special? I don't really know. Maybe they have a minimum of the amount of money. Maybe it's their best advisor. Who knows what it is? But all we're simply saying is sometimes there's specific funds like a pay to play arrangement where if you're invested in certain assets, there's additional fees that you would not have to pay if you're invested in other assets. The second common reason for underperforming 401ks is I'm normally going to start looking at your asset allocation. It's important to note a couple things. Number one is we're not only chasing the dollar. You'll find that if you're chasing the money and you're simply investing in whatever last year's number one growth stock was, it's more likely that that stock is going to be underperforming the next year. And the reason is these stocks have an average performance. And what we can do is we can look at an asset allocation and then we can say, all right, on average, using historical data, this particular asset allocation has generated a 5%, a 10% return in the stock market, which means that if I have a portfolio that generates 10% on average and it generated 50% last year, well, that means that it's more likely the next year it's going to produce negative 40% than it would be another year of plus 50%, because we know that that portfolio averages a 10% return. And so if you're chasing these gains from a previous year, it's very likely that you're actually investing in a losing proposition because that's just what the average is, right? I mean, if someone has an average of a 10% or an average of a 5%, depending on how well that stock performed or how well that portfolio allocation performed last year, then that most likely means that it's going to have less of a performance this coming year. Otherwise, the average will be much higher, if that makes sense. And I hope it does. You want to make sure that you're not too conservative and you want to make sure that you're not too aggressive. If you are someone who is near retirement, The idea is that I should be locking in some of my gains. As I'm locking in some of my gains, I'm more comfortable, I'm more secure in my retirement. And the reason is I don't want to be taking big losses when I'm about to retire within the next 5 years. At the same time, if you don't plan on retiring for the next 5, 10, 20 years, then you have enough time to allow your portfolio to grow where you've seen the impact of 1%. You've seen that literally 1% could be the difference over the life of your portfolio of someone having an additional $400,000. And that was just with a very conservative $5,000 invested every year, 7% return. But if you're someone who's maxing out your 401k, well, that number is significantly higher. So you can see that it's very important that we are optimizing our 401k based on not only our time horizon, which is how soon I plan on retiring, but also our risk tolerance. Because even though I'm conceptually saying, and we would agree in theory, that if I have 10, 20 years until my retirement, then why wouldn't I be more aggressively invested? But if you have a risk tolerance that has you up at night, you have to sweat, you're very nervous, and you risk that the moment you see a loss in your portfolio, that you sell everything for a loss, well, then we can't do that. We have to make sure that it makes sense for you and your own retirement risk tolerance and the goals that you're dealing with. And what I'll do is I'll share a video where I discuss some of these different diversified portfolios that are kind of all season portfolios. And all that means is that they perform relatively well in a variety of economic climates. Now, you don't normally have access to all of these different investment strategies inside of your 401k. Normally, they're just required by law to give you an aggressive option, a moderate option, and a conservative option. And then they may add a few more bells and whistles here and there, but you don't normally have as much flexibility and options inside of your 401k and other pre-tax plans. But we want to optimize as well as we can. One idea is, and it's not that you do it literally this way, but the idea is to suggest where we should be around. And you take 100 and you subtract your age. So if you're 40 years old, then you would say 100 minus 40 is 60. And the idea is that 60% of my portfolio should be invested aggressively. And the other 40%, I should be already locking in my gains, where I'm moving into a more conservative investment. So that'd be a 60-40 portfolio. If someone was 70 years old, the idea would be, well, I should have 100 minus 70, so 30. I should have 30% of my portfolio invested aggressively, and then I should have the other 70% invested somewhat conservatively. And you can sort of see why it's not an exact science, because for most people, it doesn't make sense to be 70% conservative in your investments at 70 years old, or invested in bonds and money market accounts and other short-term safe investments. Ideally, you're probably able to limit the risk of the equities that you're investing in, which is kind of a next level strategy. Again, all I'm simply saying is this is how we should be thinking of risk. We should be thinking as I get closer to my retirement date, the less risk I should be willing to take. Not that at 90 years old, I should have 90% of my portfolio invested safely, but that I should be thinking significantly different about risk at 70 than I did at 30. That I should be thinking significantly different about risk at 80 than I did at 50. The third common reason that portfolios typically underperform has to do with market volatility and rebalancing. If you're not rebalancing your portfolio, if you're not keeping track of the risk or the shifts in the market, and you don't have an investment strategy that performs well in each economic climate, as a result, that means that you will have a point of time that you need to go in there and rebalance your portfolio. Now, rebalancing is definitely a risk strategy. If you were able to guess right and invest and not rebalance, where you just rode the gains of a company, that is always going to outperform rebalancing. But rebalancing removes the emotional idea of investing. And I'll share a video on how you remove emotions from investing. But once you rebalance, it requires you to sell high. So you're locking in the profits. If my portfolio is supposed to be a 60-40 split, and then one of my assets is now 70% because it's overperforming, I would then sell that 10% and I would buy my underperforming asset, which is only 30% of my portfolio, which would be buying low. So you can see that rebalancing removes the emotion and requires you to buy low and sell high, versus what the average person does is they normally buy high and sell low. Where I'm getting a case of FOMO and I have this fear of missing out on the next big Amazon. And so I buy that stock at a very high price and I actually caught the end of it. So it was going down. And so I started selling it at a low price because I was losing all my money. When you have the right rebalancing strategy, it requires you to have an investment strategy in place that you will execute, and you will execute whether the market is going up or down based on the information that you've researched and how comfortable you are with those investments. Where if I like all of my investments, it's a great company, I love the leadership, it's going to grow and have a list of metrics that help me feel very comfortable about this investment. Well, I would love to buy that investment when it's on sale in the next recession. But you can see that it requires you to already have all of those data points already mapped out. So that way you are very confident when the market starts to change that my investment was a sound investment, which then means I can ride to this wave and buy that stock on sale as I rebalance. If you are not rebalancing and we're dealing with economic volatility, that means that you're going to be taking a lot of these losses. Now, of course, over the long term, historically speaking, the stock market has always gone up, but you taking the short term dips, you could end up having to climb out of a hole versus if you had the right strategy in place, you are limiting the risk and limiting the losses. So you have a smaller hole. Dare I say, you might even gain significantly in a recession. The next thing I normally look at is the 401k's performance. I'm normally going to just see what was the return that we received last year. We've already gone over the fees, we've already gone over the asset allocation, but what is my actual performance? And the way that we normally look at that is we need to look at the benchmarks. Based on how your portfolio is allocated, you would then take that percentage from these different benchmarks. So your benchmark, like your S&P 500 and your NASDAQ, the Russell 2000, these are all benchmarks where we're able to look at this index. And based on the percentage of my asset allocation, I should then be performing very similar to that index. Ideally, we'd even be outperforming the index, but depending on the overall portfolio allocation, we may not be able to outperform any one index. But if 60% of my portfolio is invested in large cap or very large companies, well, then I should expect to have about 60% of the return of the S&P 500, which on average is historically about 10%. Now, you naturally look at last year's S&P 500 to see how your performance is. And then you would go through a variety of these. Next, you have the Dow Jones Industrial Average. So that's 30 large publicly owned companies. And those are considered blue chip stocks, which is just saying that they've been around for a while and they're massive companies. They're very large, stable companies that if they went away, then we have a whole lot of problems more than anyone's individual stock performance. Because they're larger companies, a little bit safer investment, you would expect them to be a little bit lower, and they are. 7 to 9% is the historical average of the Dow. When you look at the NASDAQ is over 3,000 companies that's heavily weighted towards tech stocks, and they average a 9 to 10% returns. So if I'm comparing a percentage of my 401k's performance against the NASDAQ, then I would expect that percentage to be about 9 to 10%. Then when you look at the Russell 2000, those are small cap companies. So they're normally going to be less than 2 billion, but probably more than 500 million. Sometimes I've seen people have them at over 100 million. But normally small cap companies are a little bit riskier because they're smaller companies. So they have more issues that they have to deal with. As a result, the performance could be higher, it could be lower, depending on a particular year. But on average, it's about 8% is what you would compare the percentage of your assets that are in small cap investments. Next, we have the MSCI World Index, which is a global index that includes large and mid-cap companies from 23 developing markets around the world. And normally that's going to be 7 to 9% if you want to get into emerging markets, which a lot of your 401ks probably won't have access to that. But if you do, then you would use that index. The Barclays U.S. Aggregate Bond Index, it's the bond market, which is the debt that companies give out. And on average, it has a 4 to 5% return. So the percentage of your portfolio that's in bond, you would expect to be able to outpace that 4 to 5% historically. The FTSE All World Index, that's over 3,000 companies from both developed and emerging markets. And it's about a 6 to 7% return on average. The MSCI Emerging Markets Index, emerging markets, that's about 8 to 9%. The Russell 1000, that's the 1,000 largest U.S. stocks. So that's about a 10% average. And then the Bloomberg Commodity Index for anyone that's investing in commodities, that's normally 2 to 3% annually. So what I would do is I would take these indexes, I would find what percentage of your portfolio is from each of these indexes, and then I would take that percentage with the last year's return or the historical return, and then I can see how you're performing against that. If you're performing well, then great. Maybe the fees make sense and there's nothing for us to worry about. If it's not performing well, that's normally a great time for us to start looking at the passive investments inside of your 401k. If you're able to invest in one of these indexes, well, they're normally going to only charge you maybe a 0.3, a 0.2, even a 0.1 fee, where it's significantly less to have a passively managed fund. And as a result, you normally have two benefits. One is if they're underperforming the market and now I'm invested with the market, then I should have a higher return than I previously had. Number two is if they were actively managing it and I was paying a 1 and a 1.5% fee, and now it's passively managed, and now my fee is less than 0.5%. I've also increased my portfolio by that same amount because it's like I took the money out of my left hand and then I gave it back to myself. As a result, you can now say, all right, well, now my portfolio, I've literally increased my performance that even if I had the exact same performance as last year, because I'm paying less in fees, I've actually increased my performance by 1%, which I do think is a great strategy that you can use to increase an underperforming 401k. In summary, if our 401k is underperforming, we normally want to check against the benchmarks to see whether or not it's actually underperforming. Number two is we want to look at our asset allocation. Do we need to rebalance? Are we too aggressive or too conservative? Number three is we normally want to check the fees. Are my fees reasonable, or am I paying too much in fees where I can recoup some of my money simply from that? Number four is if everything checks off, then normally we might say we need to just invest more inside of our 401k. Maybe we need to increase from 5%, 10% to 15%. Now, granted, there are limits on how much you can place inside of a 401k in a year. It's also important to remember that because this is a pre-tax account, that means that I'm going to be paying taxes on this at regular income tax rate in retirement. So it's also a question of, do I want to pay only regular income tax when I retire? Or would I like to have some tax-free income, or maybe some just lower taxes such as capital gains tax? There are other income streams that you can take advantage of. As you guys know, the numbers say that 65% of self-made millionaires have at least three streams of income, which is why I'm big on diversifying your income stream, because that increases the likelihood of you having a wealthy retirement. Remember, your 401k is a key part of your financial future, and with the right steps, you can make sure it's working for you. If you're someone who feels that this was a lot and you think it might be something that you want to reach out to a professional, well, I'm here for you. I can create a wealthy retirement plan for you. As always, I'm thankful for our time together. If you found value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.